Hi, and welcome back to uncoverfraud.com. My name is David Malamed, and I'm a forensic accountant and fraud investigation expert of 20 years. What I want to talk to you today about is how to identify financial statement fraud. Fraudulent financial statements account for about 10% of white-collar crime incidents reported each year. And there really are 5 basic types. There's fictitious sales, improper expense recognition, incorrect asset valuation, hidden liabilities, and unsuitable disclosures. Look, complex fraud is hard for the average investor to spot, but red flags can help. For example, if you've got growing revenues without corresponding cash flows, that may indicate that there's an issue. Why? Because you would expect that when sales are growing, your cash flow will be growing at the same time. Consistent sales growth while competitor sales lag is another indicator. Why is that an indicator? If everybody else is in the market in your industry is doing bad, why is this company that you're looking at doing well? Is there something unique about it, or is this also a red flag? If there's an increase in sales and receivables mixed with growth in inventory, this may indicate that sales for dead stock or obsolete goods is out of whack, out of sync. And why do I say that? Is because as you see an increase in sales, we would expect inventory to turn over more and more. On one of the clients that I worked on once, dead stock was a big issue. What happened was stock that wasn't sold for a 12-month period would be put into dead stock and classified as zero value. But if one of those items happened to be sold, all the stock that was considered dead stock would suddenly become live stock again, and it would be brought right back into inventory. So there could be manipulation with dead stock with simply one sale of an item. What other red flags can I give you? If there's a large surge in performance during the fiscal year's final period, so just at the end, if the company starts to make a lot of sales, a lot of revenue, making up for lost time, what is it that changed? Is it something to do with seasonality, for example, Christmas time, or is it also a warning? Another thing that you must look at is maintaining consistent profit margins while the industry faces price pressure. If chips today, the prices of chips, electronic chips and processors that are going into computers and technology is dropping, but profit margins are dropping as well. What's happening is you're seeing larger sales, but that profit margin is shrinking. If a chip company is continually reporting that their profit margins are great, the question again is why? If there's a large buildup of fixed assets, the question is why are these assets building up and why aren't they being written off? One of the best ways to commit fraud is you can increase your revenue, but remember every debit needs a credit entry. The credit entry for increasing revenue is credit revenue, and then you need to debit something. So one thing that oftentimes gets debited is fixed assets. If the estimated life of an asset does not correspond to the overall industry, meaning if we're looking at printing machines and printing machines have an average lifespan of 5 years, but the company that you're looking at is amortizing it over a 10-year period, the question is what is it that makes it so unique about their printing system that they can amortize it over a 10-year period versus what the industry doing is being 5 years. High frequency of complex related party or third party transactions. One way to overstate revenue is by selling items, whether it's goods and services, to related parties. Now you're setting your prices as well as you're inflating sales with somebody that is related to you, a company that is related to you. One way to look at financial statements is to look at the verticals and the horizontals. Let's talk about the horizontals first. If, for example, a company makes $50,000 revenue in the first year, and the next year that you're looking at, we're seeing a $75,000 revenue, an increase of 50%. The question is, what's changed? as well as when you start looking at horizontal analysis, you're now looking at revenue less cost of goods sold. If revenue less cost of goods sold is about 20%, and suddenly you see revenue less cost of goods sold now being 40%, what's changed in the company? What has actually occurred that there is suddenly this greater profit margin? Look, my name is David Malamed, and I can tell you financial statement fraud is very easy to see in retrospect, but as you're a live investor going through your investments, at times you're blinded by what's going on, and that's intentional. It's not just your fault. It really is the idea of the company versus yourself, whether it's because they want to constantly beat projections, whether their revenue is tied into bonuses. These are just examples. My name is David Malamed, and I'm a forensic accountant and fraud investigation expert. If you enjoyed the video, please don't forget to like it below and to subscribe. I look forward to seeing you again. God bless.